Here's a quick roundup of all the key earnings that came out after markets shut shop today, starting with DLF. Given the COVID-led lockdown and disruption in construction activity and a slow pickup thereafter, we were expecting it to be a weak set, and that is exactly how it played out. For revenue, we are looking at a number of close to 550 crores for DLF. They reported a loss of 71.5 crores and EBITDA just about, break even, just made it 1.7 crores versus 239.7. So, yes, very weak set, but the company remains optimistic about the business and the growth returning back to normalcy. They have admitted that because of the lockdown, the residential segment was muted, and because of that, they've seen only bookings worth 165 crore during the quarter gone by. But post unlocking, they said that the company is starting to witness a pickup in inquiries, and there are some early green shoots. So let's see how that plays out. But for now, the earnings definitely were weak for this one. Moving on to Apollo Tyres, their revenue also took a big hit given the overall slowdown in the automotive space and of course, lockdown-related woes. Loss came in at 135 crores. EBITDA almost halved from where it was in the same period last year, coming in at 237.3 crores. Margins, massive contraction seen there as well, as expected, 8.4% versus 11.1% on a yearly basis. While the first half of Q1 was a total washout, their performance has been good since the markets opened up. That's what the management commentary is indicating too, especially in the replacement market. Do remember that CEAT's management also joined us on ET Now and did say that replacement market is seeing good demand recovery, and that's what even Apollo has been talking about. While the uncertainty, they say, will continue, they're hopeful that the markets will further recover and sales will bounce back close to the festive season in India. As far as Europe is concerned, they say they're performing better than the industry, and the trend is likely to continue going forward as well. JK Lakshmi, I would say good numbers coming in there despite the lockdown and the disruption that the pandemic sort of brought about with it. Revenue came in at 911.5 crores. They've reported a PAT of 50.6 crores versus 53.8 crores. So on a YOY basis, there's not been much of a compression there. Margins have seen a very, very impressive growth, 30.7% versus 27%. Talking about the volumes, they've said that the sales volume was severely impacted because of lockdown-led restrictions during most part of April to June quarter, resulting in the volumes plunging 18% in Q1. Continuing on cost savings, improving product mix and reduction in logistic costs. These are the factors that enable the company to marginally improve its operating margins. Company also managed its working capital quite efficiently, says the management, because of lockdown-led woes, and they brought down their inventory and debtors considerably as well, thanks to all the cost rationalization strategies undertaken. Next up is Nani Gas. Good numbers there as well, especially the operating performance quite impressive. Margins have come in at 37.5% versus 28.2%. PAT and revenue definitely have seen a massive hit because of disruptions and COVID-led slowdown. Volume in June came in at 0.71 MMS-CMD. MMS-CMD here stands for metric standard cubic meter per day. So this was at 0.71% compared to 0.35%. So you can see a significant trend in volume recovery that has played out as far as Adani Gas is concerned. With the lockdown continuing for 69 days in Q1, the company has witnessed a volume impact of 53% compared to Q1 of FY20. There was a progressive rebound in volumes as compared to pre-COVID situation, and exit volume as on 30th of June had already reached 1.25 MMS CMD as compared to 1.60 in the month of March. So on a sequential basis as well, there's been a bit of an improvement. Finally, you have Canara Bank delivering their numbers. PAT came in at 406 crores. Decent improvement on a year-on-year basis. NII has grown about 21% YOY, coming in at 6,096 crores. Gross NPA stands at 8.84% versus 8.21% sequentially. Has worsened a tad bit. NNPA coming in at 3.95% versus 4.22%. Provisioning definitely has come in lower. It's come in at 3,826 versus 5,375 crore rupees in the previous quarter before this. CASA deposits have increased 16%, coming in at a healthy 2.94 lakh crore. Domestic CASA share has improved by 244 basis points. Retail term deposit has also grown 13% year on year. So these are some key earnings that you need to keep on your radar before you proceed with the trading session tomorrow.